Namaskar, everybody. Welcome to the Perfect Recipe for Time series, session number 26. You will be wondering how we are doing a 26 number session first and not the 25. 25th session is on 7th of October, face to face, and it is in Hayat Place Hotel in Jumeirah. And we are this time very clear that we also would like to educate the women, and specifically the women are very important clients for us, and they're very important for the whole society, in fact. And what we have also understood is that when you educate a man, you educate an individual, but when you educate a women, you educate the whole household. And if you have your spouse, your friends who are interested to join us, please send us a email or a phone call, and we will register them. And it's a free session, a face-to-face 2.5 hour session on finance and investing, where we would like our women clients to get to the learning of investing and the investing basics. But now let's come to this session, session number 26, Perfect Recipe for Retirement series. You can see on my background, I'm going to talk about a book today. And this book, I am showing it to you here. And okay, this is the top. This book is written by a person who is managing $1 billion. I think the book is not visible, so let me go to this slide. So Pulak Prasad, he needs no introduction, an amazing fund manager who is worked in corporates like Warburg Pincus and McKinsey. He stays in Singapore and he manages a lot of endowment and pension fund. And what does he do? Is he invest our money in the Indian companies and has a great track record of 20% IRR or CAGR. And the book title is amazing, and I am part of this value group, and they have referred this book to me. When I read this book, I read a lot of investing book, but after a long time, I got to read something original. Before I go further, I would like to again welcome all of you who would have joined a little late because maybe we would have sent you the link now. So welcome to the Perfect Recipe for Retirement series 26. It's a Zoom session, it's a YouTube session, and I welcome to all of you. And today's session will try to wrap up in 40-45 minutes. We'll take your questions. If you have questions, please type on the YouTube window. I'll get the question and I'll answer it. Why do we do these sessions and who we are? So we are fund managers, general partner of Client First Capital. I myself is an investor. My investment philosophy is to invest in the companies who don't need money. What I mean by that is to invest into companies like Apple, Google, Microsoft. Though these names are very familiar, we invest into the smaller Apple, Google, and Microsoft. Why do we do that? Because these are the companies we already have a great run. We believe if you buy a company which are a little smaller than these companies, like $10 billion to $20 billion, we have a great runway in front of us. I also would like to tell you that investing is a journey where you need to share a lot of knowledge. And I do this session not for you, I do it for me. I do not want to get deviated from this path. I have seen the derivatives, I have seen the Forex and not. And I believe this is something which is doable, sustainable, and extremely rewarding. Yes, it's boring, and that's how we make it exciting. And this book is one of the excitement for all of you. And I recommend this to all of you to buy. And I also wrote to Pulak Prasad, and he also wished me all the best. And I will definitely share this videos with him because I want, this man is not in public, by the way. You cannot find him in YouTube videos. All you can get to know about him by reading the book. And this book has not been written to sell something. So more about us, we manage $35 million roughly. Our track record is 19% CAGR. We work on a performance fee basis. We have been so fortunate that we have got good clients whom we call limited partners. We cooperate this from Warren Buffett. We all are in the investing world are students of Warren Buffett and Charlie Munger. Pulak is also our ardent follower and practitioner of investing and value investing. Pulak is doing it for so long. He started this company in 2007. And what a beautiful name he gave, Nalanda Capital. and his AUM is little over $5 billion. As I speak, maybe it is 5.2, $5.3 billion, but that's not important. What is important is he is so focused and his writing is a masterpiece. He is alumni of IIT and IM, and he was India head of Vagbhat Thinkers. And his website is www.pulakprasad.com. I also want to tell you, he's not paying me for this session. He doesn't need anything, and I don't do paid commercials anyway. Why do this session? Still, I become like him or many of him, and I keep doing this so that I am on this path to help my investors and the masses to be good investor. Now, this book is published by Columbia Business School, and the book talks about Darwin theory of evolution. Now, who is Charles Darwin? All we all know he wrote about, and pardon me, I'm not an expert on the evolution theory or the biology on geology, but Darwin has written a lot of papers. I'm sure he would have got a Nobel Prize also. He also have talked about how species evolved. And when Pulak was attending one of the annual meeting of Charlie Munger, he got influenced to this book, or I think the Darwin's work. And from there, he started making a new hobby of reading about evolution. The old passion is investing, new passion is Darwin's evolution theory and evolution theory. And he started reading a lot of books. And finally, he found that everything what he does in investing has a parallel in the evolution theory. And that's how every chapter is a charismatic chapter. And I cannot tell you, after reading every 3 or 4 pages, I was going to YouTube and seeing how the species got evolved. So what interesting, I also feel my personal views, spirituality and investing are so connected. And Pulak's line, which he wrote in his book while introducing himself, that yes, I may have written the book, but I am made of various interactions and learning with many people around the world. So the very beautiful way he said that it is even not me who wrote the book. It is basically we all are creation of how we interact, whom we interact, and whom we spend time with. Now, further ado, let's do this. And I also want to tell you, this is session 1. The book really needs more time of us, and I think it needs a lot of dedication and time from all of you. And we'll do in this session 1 and then session 2. So session 1 will cover the basics. This book is not easy to read, but I will recommend all of you to read and reread and reread. Now, let's move to the approach in the book. Now, let's understand chronology. So we have written in Hindi, aap chronology samajhiye. So he has categorized the book in risk, quality, and valuation. Now, what is risk? What is quality? And what is valuation? These are 3 epitome or 3 basic principles of his investing. There are other principles which he used, and I will tell you. He buys quality stocks. He is a permanent owner of these companies as a company called Ananda Capital. And he is not lazy. He is very lazy at it, which means he doesn't sell. Why doesn't he sell? It's a very similar thing that all these people who have become rich in this world, which we also keep saying, are the permanent owner of capital of their own company, like Warren Buffett. Sorry, the Warren Buffett as a businessman, Elon Musk as a businessman, Jeff Bezos as a businessman, any, like say, Asian Paints owners as a businessman, they have never been selling their shares. Even if they sell, it's a very small portion of their share. But we fund managers always get these questions: when can I sell and liquidate? And friends, believe me, if you want to become billionaire or multi-billionaire, the 2 ways are there. One is you be an entrepreneur, innovate, and solve the problems of the world. The second way is buy great quality companies and hold them. And if you cannot understand this space, people like Pulak, people like us, very smaller than Pulak, by the way, but we are also helping a lot of individuals to retire rich. And that's what the discussion about. So now the most important thing which comes in the purview of all of us, you have to understand, we don't make you money. The companies where we invest, they make money by the virtue of selling more products, better products, better quality service they give, and selling the brands. What do we do? What's our role? The role of in the fund manager is to mitigate the risk. How do we mitigate the risk? How he has mentioned in the book about mitigating the risk, we are going to talk about. The second thing is when you buy quality, it's a linkage of the risk and quality is same, but quality, we are specifically talking about the quality of the company here, the product and the services. And then third thing is very important, which is I think a very good point here, where he has stressed on the Warren Buffett of investing style. Now, we also have to understand that Pulak has private equity background. And if you read the headlines of Times of India or something, you'll find that he is operating in the public space as a private equity investor. So you should be very surprised that he is such a patient guy or a patient investor. Sometimes for years, like 7 years, he doesn't buy. And he has this commitment from his investors. And all my knowledge is all I read in the book and from the news media and from the friends I've interacted, that he has this capital commitment from the investors, and obviously these are institutional investors. And once he is very sure that he wants to buy a company, that is the time he tells them to invest more money. So he is a net buyer in 2008, 2020, and that's how he takes care of the valuation also. So now let's go to the next slide. And it's a very important thing which is mentioned. So I'm going to run this video for you, and let's run this video and you'll understand. I'm going to repeat the video again on the screen so you'll understand. So what happened, a deer goes to drink water in a pond and a crocodile attacks on him. Okay, my screen sharing is paused. Wait. Okay. So I think you couldn't see it. Wait a minute. Stop share. I share again. Now I think you can see my screen. And I run it again. You saw a crocodile, and now I'll go back to my presentation. Wait a minute. So what happened is the crocodile attacks the deer. Deer goes to drink water, and he saves himself pretty well because of his reflexes. Now, what does it tell us? So that is what we are going to discuss in the next slide. Just give me 1 minute. I'm not able to open my slide. Sometimes technology is really give you a hard time. It's open, but I can't see it. Yeah. Rohit, can you share your screen, because I can't share my screen? Some technical problem I'm facing.
Yeah, sure. If you allow me screen share
I have
access.
already.
So I hope you're able to see the screen.
Wait. No, I'm very much technologically stuck. I feel like I have no technology knowledge. I can't even. Okay, so now I saw the. Yeah, I can see it now. Okay, we can make a bigger screen. Thank you. Sorry for the glitch, guys. So now what I was trying to tell you is how a deer saved himself while drinking the water, and the reflex was so strong. So Rose is still loading the screen.
Just 1 minute.
Yeah. So let's go to the next. So Rohit, just wait here. So there are two choices we all have in life. Either not go for drinking, because it's very foolish of a deer to go for drinking when he knows that the alligator or crocodile might kill him. But tell me one thing, what choice do we have? Do we have choice of not investing? Do we have a choice of not risking? I think even if we travel in a flight, which is Six Sigma, even if we take medicines where we have a lot of these reactions happen because of the medicine, and I'm sure you know that a lot of people get into trouble, we still have to have these medicines. So we have two choices. We die at the hands of the predator, okay, while and then we die, or we die of thirst. Now, what do I want to do? I do not want to die of thirst. I want to learn the right way of doing it. A lot of people meet us saying that I lost money, I lost money, I lost money. But not many people come and tell me that, look, I have made a checklist, and this is a checklist which I have understood that this is the reason I lost money last time. And I want to now learn the new checklist of investing. Now, why do we give an example of deer and not lion? So I don't know whether you know or not, in India, there is a project going on by the government where government basically wants to bring cheetahs from outside. And these cheetahs are roughly now dying in India because of the whatever the reason. And government has spent $12 million or something out of this. And at the same time, our lions are also dying. And we're a country where cheetahs are extinct. Lions are also getting extinct, but now maybe some of the lions are safe because of government initiative. Now, do you know the most powerful animal in this world was, let's say, for example, dinosaurs. But where are they today? They're gone. So, what we have to understand, it is not how big you are, how rigid you are, how strong you are. Your strong ability is the adaptability. And deer are still there. They are so dear to us, and they're still there. They're still drinking the water. They're still surviving. How many lions have killed how many deers? But they're still there. Why? And that's all about understanding evolution and investing both, which essentially mean a great company will adopt and survive and survive and survive. It's all about how do you improve your reflexes? How do you improve your chances of limiting your error of commissioning? Now we'll understand the next slide. What is the error of commissioning or what is the error of omission? Now let's understand commissioning first. I am a very layman, let me accept that. It takes time for me to understand things and I would go slow. And that's why I kept two sessions. So commission means you are doing something. Omission means you do not want to do something. Now, when I do something, I always do a mistake. Even the spirituality is a very clearly saying that इंसान गलतियों का पुतला है, which means when I invest in a stocks, I will go wrong, and I have gone wrong, and even Pulak Prasad has gone wrong, and everybody has gone wrong. So Pulak has beautifully mentioned type 1 and type 2 errors. It's a very thought-provoking concept, and which I would like to explain it to you so that you understand what is important in investing, evolution, and life. So there is an error when I will do something, I'll try to do something. Like today, you saw when I was doing this presentation, my internet technology is not working. And then I had to use Rohit to present the slide. Now, it may happen why I did this. I should have not done the session. I should have just kept quiet. Why I did the session. That's called omissioning. And I will never try to educate you because the mistakes happen. I also remember the famous lines of Narendra Modi, the Prime Minister, when he is speaking. And what happened? The mic gone shut. And suddenly the mic volume gone. So he said, tomorrow now newspaper will publish कि Modi की बोलती बंद हो गई. But that man today continues. So mic or technology not working is a very common phenomenon. A lot of us also write books but never publish them. It's again omission because they think that they will publish it and will not go right and they will get the bad publicity. So what is more important to understand, which we are going to see by example. So error of commissioning is false positive. When you make a bad investment, erroneously thinking it is a good one. Is it a good thinking? Good thing? No, it is not. But is it part of life? It is. So deer goes to drink water at the time he thinks it is good. No deer will go to the pond if the alligator is visible or the lion is visible. But if he goes there and if they come, it's a bad timing. It's a bad investment for the deer. But deer goes still and survive for millions of years. How many ants got killed because of our actions? But do we know the ant world is as big as the human world? So ants also have survived. So they have also would have done error of commissioning. Now coming to the deer not going to the pond, thinking that anytime the lion or alligator can come. And what happens? Many times he did not go, but lion or crocodile was not there. And since they were not there, he actually died out of thirst. He did not ever invest in himself, thinking it is not the right time to go. So now let's go to the next slide. So error of commissioning is called type 1. Error of omissioning is called type 2. What statement we are giving here is, if you want to increase the success rate of your investing life or the life in the evolution or in general in business, we all have to learn to say no, or we have to learn to say to reject well. Example, we go to a place, and if we eat less, if we are good in identifying what is good for me and what is not good for me, by identifying what all are not good for me, we will be better in living a good life. So now minimizing the type 1 error increases the odds of success significantly. Now let's take this example of the stock market. Assume there are 4,000 companies in this universe of the stock investing. So let's say in America, 4,000 companies are there. So if you remember, Russell has 2,000 companies, S&P has 500 companies. So overall, that's it. There are 4,000 companies. Now, type 1, an investor says 80% I am correct. Whenever I invest, 80% of time I am doing the right thing. What does that mean? That means that the investor will buy 800 correct companies. So Rohit, if you can write down on the 1.1 and you can write down the 800 companies. So now investor has taken 800 companies which he selected, and it's called basically 20% of type 4 error. He is good in buying good investment. Now, how is the universe is evolving? The universe is 1,000 companies are good. So down the denominator will come 1,000 companies, and then out of the 3,000 companies, okay, again he is good at rejecting. So what happens? Again, he will not be selecting 600 companies. So 800 plus 600, 1,400 chances he will be selecting 800 companies. And that's how his success rate will come something around of buying good investment is 57%. So it is here. If you have not understood, please write on the YouTube chat. So type the first investor A, he is having 57% good investment by keeping his type 1 and type 2 at 20%, or type 1 error and type 2 error to 20%. Now let's say he is improving type 1 error, which means now he is able to identify companies 90% time correct, which means his basically rejection rate is improved. So now what happens is, this man goes and select how many companies, Rohit?
So as Bhuvan was saying, that let's assume for a moment that we try to minimize we try to increase our effort to minimize type 1 error. So type 1 error, what we are saying is that he chooses from the bad set of companies, he chooses less companies. So what we are essentially saying is that we have already established from 4,000 companies in the whole universe, only 25% of the companies are investable or are good companies, right?
Right.
And the second thing that we do is, and we are also assuming that 80% of our time, the investor is correct. So from 4,000, we have narrowed down to 1,000 companies, which are good. Now, of the 1,000 companies which are good, only 80% is chosen by the investor. So that means 800 companies, right? But that's not it. He also mistakes 3,600 companies of the 3,000 companies as good companies. So his investable universe becomes 800 of the good companies plus 600 companies of the bad companies. So when we reduce type 1 error from the 600 companies, it falls down to 300, right? So the investable universe becomes 800 of the good companies together with 300 of the bad companies, which he considers good. And your denominator is 1,100 companies. Again, when we do a probability of the success rate, that is investment will go correct from these 1,100 companies, it amounts to 73%. So just by a mere reduction of the type 1 error by 10%, the success rate that the investment works out exponentially increases by around 16%. Right? I think I should hand it over to Bhuvan. Right?
Thank you, Rohit. So now the other way what he does is he improves his selection of buying the good companies. So when he improves that, basically he is minimizing the type 2 error. So what happens when you do the math again, you get a success rate of 60%. It is a marginal improvement of only 3%. Now the math could be looking very difficult because of the probability calculation here. But the message here is very simple. We all should improve in our rejection thesis. We should all improve in rejecting the bad outcomes. And we cannot become a great investor by only and only focusing on not buying companies overall. Because we all have to take risk, but we have to become good in mitigating the risk by improving our type 1 error. And that is what the very crux on the session 1, which we would like to share. Rohit, can you share the screen again?
Yeah, just 1 minute.
Yeah, so I think it is working on my screen now somehow. Okay, so there's a technology issue. So this is very important. I repeat, we have to become a great rejecter. That's how we can improve our success rate from 57 to 73. But if you think we can, even if we reduce the type 1 and type 2 together, we can still, success rate will be only 75%. So great effort, but the improvement from 73 is only 2%. It is better that we become a great rejecter. And because of that, our success rate will become 73% from 57%. And that is a message we want to give it to you. So now coming to the book also talk about convergent patterns. Now, what is convergent patterns? Convergent pattern is basically, if you see in this particular, what do you call, the photo from the book, it talks about the embryo of human, chicken, turtle, salamander, and fish. In the first phase, when it is in a very early stage of embryo development, it is very difficult for us to figure out, or anybody to figure out, the difference between the human, chicken, turtle, and salamander, or let's say at least 3 of them, human, chicken, turtle. The difference is very, very difficult to spot. But as they grow, we can see that the difference is increasing. Similarly, in the life and in the investing, the patterns are convergent. they are very similar. In the life of evolution theory and the investing, the value investing, the patterns are very convergent. And that is the message of this. So by looking at the track record, the past, or the culture, we always say, look at the culture. When we do arranged marriage in our Indian culture, we always look at the family. We do not only look at the beauty of the girl or a boy or the richness of the boy, we look at the culture family. So that is what is being said here. Now, how do we found the hallmark of a quality business? So Pulak talks about a lot of parameters. He talks about the EBIT, he talks about the earning growth, he talks about the revenue growth, he talks about the capex, and then finally he says everything is covered in one particular parameter in the financials, which is written on capital employed. So look how beautifully he reached the same conclusion of return on capital employed, which you as an investor or I as an investor would have reached some other way. How did I reach on the ROC? My understanding was if a businessman doesn't make money on his own capital, how he will gonna make money to me? And how Pulak reached here is the convergent pattern theory, which says that ROC is the single most parameter to understand how a great company functions. Does it mean this company may not go wrong? No. But does it mean can I increase my type 1? Can I minimize my type 1 error? Yes. And that's why if I reject all those companies of ROC less than 20 or 25 or ROC less than cost of capital or very the difference is low, then I can become a better investor. Now, this has not been taught. What Pulak also mentioned, this has not been taught in the school. We have been taught to be good. We have not taught to reject bad outcome. We have not been told how to understand who are the bad people, who are the bad, what are the bad opportunities, what is not to be done. All this should be focused. We're always focused on being good, good, and good and good. But if we've been taught, don't do that, this is not right, this is not good, this is not good. If all those will be told to us, we will improve being a better human. And similarly, the consistent return on capital employed is the major criteria, which I think in investing, it is not taught even in the colleges. At least I have not been taught in my MBA. So I don't know if you have been taught. If not, please work on it. It's a great subject to know about the return on capital employed. The second thing, no debt. Now, if you remember our forefathers, they were always against the debt. Now, this is something they have been taught pretty well. Now, gives us liberty to take business risk without the burden of financial risk. Now, this is very important. If somebody who is taking a lot of debt, it means he doesn't have internal cash flow generation, or he doesn't command the market pricing, or his business is not favorable to economics. And which are these businesses which have got heavy debt? Government businesses, PSUs, mining companies, utility companies, and a lot of capex heavy companies have full of debt, and even the startups. So we have to be very aware of these companies and try and avoid these companies because they can't take a business risk without raising more money. So we need businesses to take risk, but we want it to come without the burden of financial risk. Now, there's a very important point he said, look at the industry as an outside view. Now, what are the outside view of an industry? A very simple thing. So let's say, for example, you are investing with us and we are doing value investing. So you understood our process, method, etc. But then you found that there are no parallels to us. There are no people in this world as a fund manager in the value investing approach who makes you money. It's an outsider view. So then you should not invest in the value investing. Similarly, if you are as a stock picker, if you see an airline company or an apparel company, they don't make money. A utility company, they don't make money. a very good thing which Pulak has very brightly, very, very intelligently brought it out. If the industry as a whole does not make money, which means if I am buying Apple, but other phone companies are not making money, then I should not buy Apple. He said there are exceptions like Tesla and Amazon, and I'm very happy to reject them. And if you think that this is the reason you don't want to invest with us, that's absolutely fine. Amazon is a great example of A to Z. But how many examples are there like that? So he says, I would stick to companies which are selling in one industry, doing small acquisitions, and very focused. Where Amazon is selling A to Z, Tesla is doing what not, and these companies are not faring well in these figures. And I own Amazon, so I know ROC is not that great. But still, people invest and have made money in Amazon. So in this cases, some of the investment we will miss. But as we rightly saw in type 1, type 2, even if I improve my type 2 error with a great percentage, I might not be a great investor, or I have to be a very genius, which I am not. And even I am very much impressed that Pulak Prasad, who's an IIT and IIM alumni, he is also writing, I am not a genius. He also says, what have I done in my life? I have not run any business before this. But then he said, I have been an observer. As a consultant, he has been observer. He has an outside view. And I think that's very important. While we trade in the business, a trader, and while we invest as an investor in the business, there are two different things. And Pulak said, my observation in this of the industry has helped me to be a great investor. And that's a very honest confession. And see how all these great investors giving great track record and great returns, and such a patient man he has that he doesn't buy even for 7 years. He is saying that I am not that intelligent. And he also says one more good thing. My idea of investing is to sleep peacefully in the night. And that's what the idea is ours. And that is why we are doing this session. We can't have him for your session because obviously we do not have that much of reach with him. But one day, finally, maybe he will agree. But he is not a person who is very famous in terms of giving interviews, not at least what I know of. Now, coming to the last part of the quality business, longevity and adaptability without changing the core DNA. Now, that is a very good point. He figured it out. He said, there are so many companies who survive. So there is always data goes on in the market that how many companies in the S&P 500, which are there 30 years ago, are still there? And the answer comes out, very few companies. So Pulak did his Bloomberg research and figured out, and with his research team, he figured out that it is not true. Yes, there are companies with the same name, they are few in the S&P 500. I repeat, कुछ कंपनियां as it is S&P 500 में अभी भी हैं 30 साल के बाद. But majority of the top companies those days are still there, but they are acquired. So they are also right now there. They have adopted well, and they have got merged or acquired or changed their name. So what Pulak is saying that the way deer has adopted maybe, and they also did a very good experiment of fox. So in Russia and I think Bulgaria somewhere, they did an experiment. It's a very famous experiment. And this lady was employed by the scientist. I'm not going to the names and all, because the different Russian and the names not easy to pronounce. What happened? They started this experiment with fox, and they started taming. They started basically making the fox pet. So let's say one fox gave birth to 6 foxes, and then they found that one of the foxes very amicable. Then they allow only that fox to reproduce. Then they got, let's say, 5-6 foxes. And by the way, tell you, 18 months down the line, a fox get elder and it produce baby. So in a human life, you can actually have a lot of these foxes. Then what happened? Again, they found this fox is very pet and not wild. Again, they allowed them to only reproduce. Like that, finally, after 6,000 kind of foxes, they found foxes species which are used by people like you and me as a dog, as a pet dog at house. You can see all this on the YouTube. And in America, also now there are 10 to 15 foxes, which are pet foxes. And that is how they have this adopted, but they're still fox. But why these foxes are good than the dog? Because the main DNA of foxes, they can jump, they can go down in the earth, and they can get the rat out. So, and they also have a great smell ability. So they can be used in the military, in the spy world, and that is a longevity and adaptability without changing the code. That's a very good experiment which is mentioned. So what he says, a very important thing, we don't love the business. Business is the outcome. We love the way business is constructed. And I think this is nothing but culture. The culture is the most important. It is the people behind the business are more important. And if we understand that, I think the quality business can be not be hidden from us. Now that is how I would like to. Now the last slide, I'm going to end my session because I would like to conduct one more session and give you more detail. Now a lot of news we read nowadays and a lot of news we watch. I'm sure all the savvy trader and investors, they see their screen every night before they sleep, the screen. I think also Pulak wrote in his book, he has a Bloomberg terminal, but he has kept it in the gully, or where if he has to get some information, he has to get up from his seat and go, because he wants to avoid seeing the Bloomberg again and again. And I'm very proud that he's not the only one. There are many successful investors. Even we have not taken the Bloomberg subscription. They don't use Bloomberg. And now what happens if you see Bloomberg, or if you see last 1 month of drama, you saw the Fed rate, that government shut down, and maybe first of this month the government will shut down. S&P 500 has also gone down 4% of the. Now these are all called proximate paranoia, and they are not a reality. They're not really changing anything about you fundamentally about your business. Why stocks may just roll into an October correction? Every month, every week, you are sold on these headlines. The stock market looks like dot-com boom before the bust. Now, this has happened again, maybe 90, this news has come, right? All I'm trying to tell you, these things are confusing with the ultimate reality. And they are absolutely not important. And that he has mentioned using the evolution of species. And he says, you might see a sudden change in a short period of time, but changes, the ultimate changes are actually slow, and they happen over a period of time. There's a very good saying that mining takes time and politics is fast. When you invest in a great company, it might take some time to make money. And that's what, in my opinion, is the meaning of this particular slide and the book where I read. And he said that's why, and I'm folded hand requesting all of you who are on the YouTube right now and are my investors or would like to make money. Stock market players play a very complex guessing game said by John Maynard Keynes. And let me tell you who is John Maynard Keynes. John Maynard Keynes was Fed chairman. I am reading a book called Concerted Investing. The second investor mentioned is John Maynard Keynes. And John Maynard Keynes was a very bright student and was from the Ivy League college. I think he went to Cambridge to study or Oxford to study. And I think it is called Sir John Maynard, he got a doctorate degree. And he knew about the commodity, he knew about the oil and the stock, the market and whatnot. People were taking a lot of advice from him. And that's how he made his portfolio, and he had got leverage and everything. And you know what happened in 1929? He actually lost a lot of money. This happened with also Ben Graham. So it is written in that book. 20 years it took for John Maynard Keynes to realize that value investing is the only investing. It's a sure short way of making money in the stock market. So my sessions are all education sessions. I'm not selling you anything on this session. all my request is to not to do mistakes or commit mistakes which we have done in our earlier avatar. And please do not, it is all news headlines are bullshits. They are selling their news. And I have nothing against them. There are people who would like to buy these news. But if you want to make money, we need to be looking at the quality businesses, understanding the risk and the valuation. And I will cover these in the next session. As rightly told you, this is a session which we're going to do in 2 parts. And we'll discuss more about the book. Do you have any questions? I'll wait for a minute. If I get from my team any question from you on the YouTube, I'll happy to go. And just to add you one more thing, which also he mentioned, I think I forgot to include in the slide. Till you please write the question and give if you have. We run Founders Portfolio. Now, there are enough which we want to know about our existing companies. Now, what is more important? The track record of our companies, how they are run, the financials, the details, their products, how they have made a culture, the kind of culture they have in the company, should we focus on that, where we already have a lot of information and we remove our confusion, or should we talk about the forecast, which is not even there? It's also said very well, past is a history, future is a mystery, and present is all what we have. All this track record we have in the present, we should try and increase our knowledge about them rather than try to waste our time in forecasting. So John Maynard Keynes also tells the same thing. We are also telling the same thing. Let's live in the present, analyze the past in the realm of present, and be very hopeful, mitigate the risk, and invest in the great company or with the great fund managers, because this is not a something which a common man can do unless until he is absolutely peaceful. And I totally agree that there is so much of noise in the market. So these sessions is a way for me to be on this path. It's a way for me to tell you to be on the path. And if you will be on this path, the money will be made. With that, I think I'll take your leave. I think there is no more questions. Thank you for patience. Sorry for the glitch which has happened. It's an education session. I want to remind you again, 7th of October, we have a face-to-face session in Hyatt Place in Jumeirah for ladies, and would be very happy if you have any friend of yours who would like to attend. We will be covering right from the basics of investing to the value investing. Thank you for joining in. Thank you for tuning in on the YouTube, and please write to us, give your feedback. We'll be happy to cover it, and please read this book, and we'll meet you soon with the second session. Thank you for attending Perfect Recipe for Retirement Series, session number 26. Alvida.